Yo, what is good guys? Welcome back to a new video. Inside of today's video, we're going to be covering one of the most key concepts within trading in general, not just quarterly theory, but in general, and that is draw on liquidity or DOL, okay? Essentially, the draw on liquidity is one of the most important trading concepts. Without it, you are essentially trading blind. Without knowing the DOL, every concept and model out there will fail. A draw on liquidity is an area the price wants to draw towards, and there are many ways to identify them, okay? So there's a quick little brief overview. As you can see to the example on the left, it's essentially points in the market that price wants to draw towards, okay? So if you're, looking for shorts here, but price wants to take this high, your bearish concept, your bearish model is going to fail, okay? So what we're going to be doing is covering the different ways in which you can find the draw on liquidity, the most effective ways, and how to know, if the draw on liquidity is actually real and if it's going to hold and whatnot, okay? So let's just jump straight into it. So the first draw on liquidity is previous X highs and lows, which can be previous quarter high or low or previous candle high or low, okay? As we all know, a quarter is and can be a candle. For example, if you're trading the weekly cycle in terms of quarterly theory, the previous quarter high is essentially the previous candle high, the previous day's high, okay? So as you guys can see on the example to the left, previous day's highs and previous day lows act as great draws on liquidity for that intraday, that daily bias. If you're coming into the day bullish, you want to be trying to target that previous day high, for example, okay? Same thing with trading the quarters, intraday, can be on the 90-minute cycle, microcycle. If you're bullish for that specific cycle, you want to be targeting the previous quarter highs, and if you're bearish, you want to be targeting the previous quarter lows, okay? So if you look back upon all the previous candles / quarters, they all have something in common. They almost always take the previous candle high or quarter high or low, okay? So literally go back in your charts, look at the daily candles. What does almost every single daily candle do? And not even daily, but every single candle in general, like even on the 15, the 5, the 1 minute, it almost always either takes the high or the low of the previous candle. So that can be one of your most prominent, your most strong draws on liquidity. Once you've established that bias, that is your main draw for that current candle that you are trading, okay? Now, our next draw on liquidity that we have is unmitigated gaps. So an unmitigated gap is essentially a fair value gap that has not yet been traded into, okay? As we know, price likes to reject away from gaps, but before it can even reject away from one, it must first trade into that gap, right? So as you guys know, fair value gaps are great for holding price. You can look for trades inside of them, but before price even gets inside of them, it has to draw into it, right? So not only can you take trades away from gaps, you can also take trades into gaps, right? So if you see, 2 or 3 or even one huge gap left behind in price, you can often anticipate price to pull back into that gap, right? So price will usually seek a fair value gap after liquidity has been taken, and think in terms of external range liquidity taken, right? And then back to internal range. So once we take those previous days highs, that previous quarter high, previous quarter low, then we can look for that move back into internal range liquidity, which is essentially fair value gaps, okay? So as you guys can see in this example right here, price left behind a pretty decent size fair value gap here while offering a reversal candle signature as well, so indicating lower prices. And then you could have looked for a short into that gap right there, okay? So open high, once price was all the way up here, you look for a short in towards this gap over there, okay? And like I said, it often works great when there's many gaps left behind, when price is super overextended. At that point, it makes sense for price to retrace, rebalance those gaps, right? So that's unmitigated gaps. Next, we have a low resistance liquidity. Now, this is one of my favorite types of liquidity. Low resistance liquidity is multiple failure swings in a row. So instead of seeing price take liquidity, it actually fails to do so, and as a result of this, builds up even more liquidity, right? So once the low resistance liquidity has been built up, it then acts as a great draw, and price often slices through it very cleanly, okay? So visual representation of low resistance liquidity is multiple failure swings in a row. So it's like trend line liquidity, okay? Imagine pulling a trend line just like diagonal of loads of liquidity left behind or down, for the highs. As you can see, 1 failure swing, 2, 3, 4, 5, 6, 7 right there. So 7 failure swings all in a row. And then as you can see, the delivery to those low resistance liquidity lows is very clean. Price just slices through them cleanly, no hesitation, just straight through all of them. almost, within 4 or 5 candles or so, okay? So that is what low resistance liquidity is. It's essentially just points in the market where there's a lot of liquidity built up, and price often delivers straight through it very nicely, okay? And now final type of liquidity is equal highs and lows, okay? So I'm sure a lot of you guys know what these are, but essentially equal highs and lows are 2 liquidity points that align with each other perfectly or almost perfectly. They act as a great magnet for price. It's essentially the market leaving behind multiple points of liquidity, therefore making it a high probability draw for price. So like low resistance liquidity, it's essentially the market failing to take liquidity in the first place, therefore building up more. Therefore, that area where it's built up the liquidity becomes a very strong draw for price. So as you can see in this example, we have liquidity here, right? Then price was drawing towards it. It just failed, creating almost perfectly equal highs. Bear in mind, equal highs don't need to be the exact same level to the tick. It can be a little bit lower down below, as long as it's like pretty clear like that, equal highs, right? So as you can see, equal highs left behind, price retraces lower and then delivers very cleanly towards those equal highs, okay? So whenever you see equal highs and lows on your chart, they often do act as a very nice draw on liquidity. So yeah, with that being said, that is going to wrap up this video. Just nice, short, to the point, liquidity explained in under 7 minutes right there for you guys. The 4 different types of liquidity points I like to use. And yeah, once you pair this with the candle closures and the cracks and correlations, and then you identify the draw on liquidity with a clean model, you're going to be, good to go, and you're going to be navigating these markets very, very well. But yeah, with that being said, hopefully you guys did find this useful. I'd appreciate a like, a subscription, comment down below any questions that you've got about these liquidity concepts that we spoke on, or any video ideas that you would like to see from me, as well as a link to apply for my one-to-one mentorship if you do want to work with me one-to-one and see, fast and great results within your trading, and work alongside myself. And also links to my indicators down below, my premium membership group, and also code BOOKO at all prop firms, all the big ones out there in the space, for the best discount. But yeah, with that being said, appreciate you guys for watching. Good day and good trading.